So just for completeness here, the Bank of Canada is meeting on June 5. That's on Wednesday. Currently, as we talk, an 81% chance of a rate cut priced in. The
Yes.
European Central Bank is meeting a day later on Thursday, a 96% chance of a rate cut
Yes.
priced in. If you ask a federal official, they will always say, no, 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 we are focused on U.S. economy policy. We don't care. In practice, of course, they communicate, they talk. They do focus, of course, more on the domestic economy. They will care about what's happening in the rest of the world if it affects financial stability in the US.
Has a prospect of a U.S. recession become so unlikely it is now a black swan? Well, what happens if the consensus is wrong? We're talking about this, market implications of a recession risk, and Friday's data release for inflation with our next guest, Axel Merk, president of Merk Investments. This episode is brought to you by iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%, and gold holdings as well. If you'd like to learn more and get started, click on itrust.capital/David in the link down below. If you use my referral link, you'll get $100 in signing bonuses. Axel, good to see you again. Welcome back.
Great to be with you again.
I'd like to start by talking about this article we were mentioning offline. This came in from Bloomberg. The title is "The Black Swan Risk is Now a U.S. Recession." First paragraph: a soft landing for the U.S. economy has now become such a consensus view. It makes sense to consider the risk that something else occurs and what that means for risk assets. The data suggests the possibility of a recession is greater than commonly understood. And then in the article, they've attached a chart from the Federal Reserve showing the probability of a recession as predicted by the Treasury spread, currently at 50%. It was at 70% some months ago, so it's come down, but still significantly higher than any other period since the early 1980s. So let's start with that framework before we talk about recent economic data releases like the inflation report that came out on Friday. What is your view on this? What's your reaction to this article?
Sure. Well, let me take a step back maybe as to why we care in the first place. We care about recessions aside from our own job maybe being at risk, is that risk assets tend to do better during economic expansions. In a soft landing scenario, risk assets often do just fine. In a hard landing, risk assets tend to perform very poorly. And that's why there's a huge industry dedicated about forecasting recession. And of course, as anybody who's been paying somewhat attention in recent years knows, this is the most forecast recession ever that hasn't quite happened yet. And I certainly don't claim to have a crystal ball either, but my job as an asset manager is to look in the world in terms of risks. And if risks are significant, I take them into account. And I argued a year ago already that, hey, the weak point in the economy might be just before the election in the US, and that might have an impact there. Now, clearly, the economy has held up better than many people anticipated, including myself. I have always argued I bet on the consumer, and the consumer is somewhat weakening. We see a bit of a bifurcation in the consumer, to be more precise. The high-end, wealthy consumer, high-income consumer is doing just fine. But inflation hits particularly hard the weaker consumer. Inflation has been more pronounced than the sort of goods that the lower end consumer is supposed to. Credit card delinquencies actually just had a tick downward, so they're hanging in there. And of course, the context is that these higher rates don't affect everybody the same way and not as much into the past and so forth. But overall, yes, I do think, I mean, Jamie Dimon said that as well, that he thinks that we do have to take the risk of a worse economy into account. Now, for full disclosure, right, we manage over $1 billion in gold mining. That tends to be doing better during recessions. So maybe I have a bias to which I look at things. But I do think that this consumer is going to get weaker. But at the same time, this huge deficit we have on the fiscal side is one of the reasons why this economy is holding up better, because that's an implicit stimulus.
You know what's interesting is that the other G7 countries have all fallen into technical recession at some point in the last 12 months, except the U.S. Why do you think that is?
Well, I think it's the enormous deficit that we have that's an implicit stimulus. I think that's the key driver here. There are other factors. We have such a micromanaged economy these days by the Federal Reserve. As a reminder, a little over a year ago, the Fed gave this lifeline to the small banks where they converted a an acute into a chronic problem by allowing them to kind of shield their interest rate mismanagement, their commercial real estate exposure. The refinancing has been sluggish in that area. And this is kind of the Bernanke world. Bernanke wrote a book during the pandemic where he envisions a world where the Federal Reserve can be ever more micromanaging. He doesn't use those terms, but that's what it amounts to. And my view as well, if we convert to a command economy, yeah, maybe we can get rid of recessions altogether. But we're taking away the free market mechanism from more areas in the economy, and sure, that works for a while. There are side effects. We can talk about those, but that is part of the reason why the US economy is held up better. And the other one is, of course, that people have refinanced their homes. And on the commercial real estate side, the day of reckoning hasn't been there. In Europe, by the way, that's starting to get into a higher gear where there are more defaults and a little bit more of a flushing out in the commercial real estate side.
What sectors do you think are most at risk right now, if there's any risk at all right now?
Well, on the valuation side, the question is, what is at risk? Is it layoffs or valuations in the markets, right? On the valuation side, obviously, there have been a few darlings that have been the main beneficiaries of the flows. And in recent days, the software side of things in particular, there have been some setbacks. And I'm not giving any investment recommendation here, but when a company like Salesforce says that they are struggling a tad, to me, that might signal a broader weakness. We've had companies like Amazon and Walmart say they're giving more discounts. Those are signs that there is a weakness somewhere. Now, it's a diverse economy. It's a broad economy. These things never matter until they do, right? And so some people are saying, yeah, you got to look at the yield curve. Well, the yield curve being inverted, right, hasn't quite worked. The recession hasn't come yet. And so ultimately, it's a question of risk management. And then at the other end of the spectrum for the investors, there was a question, what can you afford, right? Can you afford the risk of having a 20% plus downturn in your portfolio, or can you not afford it? If you cannot, you may not want to be as exposed to the market. The biggest mistakes that people make is that they rebalance too late. People haven't gotten bankrupt if they reduce their spending and are more risk averse in their investments.
You brought up a very good point, which is fiscal stimulus. So as you know, the Treasury General account swelled to $930 billion, right? This was farther than their $700 billion initial target. Do you think Janet Yellen is going to start pulling this back at some point?
Well, you live happily ever after, right? I mean, you do what the market can bear. You dealt with the numbers, right? You as a Treasury Secretary, of course, you have some flexibility. You have flexibility where on the curve you refinance, but ultimately, it's the deficits that dictate when you have to go to the market. And the one thing we know from Greece and the European experience is that politicians don't come to their senses until the market forces them to, and we are far off from that. And so I think both political parties we have in the US have shown that deficit spending is popular with the electorate. And so we always talk about spending money better if you only elect me. But I haven't seen really that fiscal discipline is the top thing on people's mind. It may be as part of a protest, right? I vote this guy out of office because I want more fiscal discipline. Whether we get that at the end of the day is another question. But to the extent that we did, let's just assume for a moment we had a change in the White House in the US and we had more fiscal discipline. Well, that would be bad for economic growth in the short run anyway, right? In the long run, it may be good if one doesn't waste as much money. But in the short run, that may well mean a deeper recession.
Today's data, core PCE, which is the Fed's preferred measure of inflation, came in annualized 2.8%, which is exactly the same as the previous month. 2.8% on a month-to-month basis. It rose about 0.2%, which is more or less in line with expectations. So the question is, why did markets react the way that it did? Or perhaps it was reacting to something else, because I'm looking at my screen right now. The NASDAQ is down 1.4%, which is significant. The gold price is down 0.6%, and the dollar is, well, more or less flat. But stocks and gold both down today. Are they reacting to something else, or this, you think?
Yes, I mean, the breaking news is it's the last day of the month in May. I think that is far more relevant. That
Back
is
to
far
work,
more
everybody.
relevant.
Yeah.
And there is some profit taking. There is a repositioning. There's window dressing. You call it what you want.
Yeah.
But these numbers are pretty much as expected. Relevant here from the monetary side is, I believe still that I positioned it last October, some put it last December, but Fed Chair Powell last October gave what I call a mission accomplished speech. He was then more explicit about it in December. It's the change in bias at the Fed that really matters, and that has given a positive spin to the market. It has given the direction where we'll be. It has allowed other central banks around the world to kind of follow suit. The European Central Bank is likely to cut rate next week, although their inflation numbers released today were a bit worse than expected. And so now, why do we have a sell-off in equities? And by the way, we're talking before the market closes, so who knows how the market will close at the end of the day. But I wouldn't, to take a step back here, right? I mentioned earlier the market and the Federal Reserve is ever more micromanaging these markets. One of the side effects of that is that the market is giving ever less information. Pre-2008, you could look at the yield curve and get information. You could look at the New York desk of the Treasury. They would see when they manage the interest rates by interfering in the markets, by buying and selling Treasuries. Are there any weaknesses in the banking side? Nowadays, by paying interest on reserves, that is gone. And what that means is that these very smart people at the Fed are reading the exact same tea leaves that you or I are reading. They're looking at backward-looking data, and they're trying to make a forward-looking decision. A key difference is it's a committee of many people, so their reaction time is much slower. They have their own biases, and indeed, unlike the market as a whole, most of the folks at the Fed and central banks around the world have the same sort of training, and so they have their own biases, which means they're going to be late, and which also means because they have the bazooka, we're going to put every word that they say under the microscope, but they don't know anything more than we do, and so they're going to be driven by a backward-looking thought about what inflation may do, plus their forward-looking bias, which basically means nothing has happened because they have said that even if inflation is still above 2%, they don't really care because they think that at the current rates, there is a tightening bias, and that's good enough for them. And so that's why my conclusion is that it's Friday in May is far more important than what the number today was.
What do you think the Fed is going to do going forward? Now, let's take a look at what other central banks around the world are planning to do. So here in Canada, I'm hearing rumors that Bank of Canada may cut rates this summer. The governor of the Finnish bank, Bank of Finland, recently this week said that he expects the ECB to cut rates by June, which is coming up. You know, other central banks around the world are acting dovishly. Will this affect Fed policy?
So just for completeness here, the Bank of Canada is meeting on June 5. That's on Wednesday. Currently, as we talk, an 81% chance of a rate cut priced in.
Yes.
The European Central Bank is meeting a day later on Thursday, a 96% chance of a rate cut priced in. If you ask a Fed official, they will always say, no, we are focused on U.S. economy policy. We don't care. In practice, of course, they communicate, they talk. They do focus, of course, more on the domestic economy. They will care about what's happening in the rest of the world if it affects financial stability in the U.S. And so I mentioned earlier, right, the commercial real estate market in Europe is starting to flush out. Well, if that creates hiccups in the banking system, and I'm not suggesting that it necessarily does, but assume for a moment that credit spreads were to blow out there and so forth, there will be more uncertainty in the market. Those jitters might swap over to the US market. I'm talking hypothetical here. I'm not saying that will happen. But if that were to happen, then it will get the Fed's attention, right? But other than that, they probably could care less what's happening in New Zealand or even in Canada. And so they will be very much focused on what's happened domestically. And also, when something does happen internationally, remember, most of the folks at the Fed are academics. And so they only realize there's a problem when it whacks them in the face. I think that's a technical CFA level 3 term. If something really derails, then it will get their attention, and then with a lag, they will react to it. But they will not do anything preemptively saying, hey, something might happen in the rest of the world, therefore we shouldn't be cutting rates or raising rates or keeping them where they are.
Going back to the first part of our conversation, that 50% probability of recession is coming from the Federal Reserve researchers, right? They're economists themselves. They're looking at the same data that we are, and yet they're probably not reacting right now. What we don't know what's on Jerome Powell's mind, but if I were looking at that data, I would be thinking, well, higher rates for longer may raise the probability even more, risking the economy. He doesn't want that now, does he?
Well, he would like to have the economy be a tad weaker than it is, I think, because inflation is still higher. Now, they say they have a 2% inflation target. Larry Summers the other day spoke up and said the Fed should not get rid of its numeric target. And I'm fine with that, except then he added, in situations like this, they could target a slightly higher inflation. And that's, of course, something that a central banker must never say, because the moment you say that, what stops you from changing the inflation target every week, every month, every year, or whatever it may be? You're losing the credibility of that anchor. But at the same time, the Fed is perfectly happy with a 2.8% inflation that we have right now. But they give it lip service that we'd rather be at 2%. So they're happy with the slight tightening bias. They certainly don't want to ease. But you're absolutely right, of course. The Fed policy acts with a lag, and that historically means that when the Fed wants to tighten, we get a recession because they will be late. It's one of the reasons why I believe that discretion should be all but eliminated from Fed decisions, because a committee will always be late in reacting. And we saw, of course, the horrendous implications of that when they were too late in hiking rates. And on the way down, it's quote unquote just a recession.
I'm curious to get your sentiment on stocks, Axel. Some Wall Street firms, UBS, for example, has recently lifted its outlook on the S&P 500 for the year. Where do you stand on this? Are you lifting your outlook? Are you staying neutral? Are you more bearish?
Well, anecdotally, just on international allocation, I talked to somebody the other day who had been investing internationally and saying, oh, look at that, it's been losing money. And yes, it has lost some money, but the data, first of all, didn't include the dividends. International stocks tend to pay higher dividends, so it looked worse than it did. But see, the US is doing much better. I don't expect that to change in the coming years. Now, of course, and again, I'm not giving an investment recommendation, but a company like NVIDIA has, of course, had a great run. And in contrast, some of the stuff in the rest of the world has had a rather poor run. And so that means really nothing about how things will go forward, but one is a lower valuation and one is a very high valuation. Now, I'm a value guy, so I tend to like things that are of quote unquote good value. Institutionally, we manage currently just under 1.4 billion in gold and gold mining. So of course we kind of institutionally like that space there. And what we like there on the mining side is that change in bias that came after last October. Keep in mind that when the Fed is in a tightening phase, that provides tighter financial conditions. Many of the small mining companies need access to credit because they need to periodically finance the next phase of the expansion. So that's a more favorable environment. And in a recession, especially a severe one, could be very favorable to them. On the general equity side, right? I mean, there's the saying, as I indicated earlier, that equities tend to do just fine when you have an economic recession. They should do okay. When you have a soft landing, it's the hard landing you want to be concerned about. And so I mentioned already a year ago when I expected a harder landing, that unlike in 2007 when I sold all my regular stocks, talking about my personal portfolio here, I didn't do this time around. but I haven't added to that allocation. I've kept it at a fairly modest level compared to most investors. I have a much bigger allocation on the mining side. And I'm very happy with that. But I've also diversified to various other areas outside of the traditional capital markets, ranging from forest to other areas, some real estate investments as well, and so forth. Right, to be more broadly diversified, because I don't like everything that I see in the markets. But I don't see I don't see a 2008 crisis, which would get me completely out of the markets.
You don't see a 2008 crisis. Why would you need a crisis to get out of the markets? I mean, perhaps you just see other opportunities in other asset classes.
Well, sure. To me, it's about risk management and asset allocation, right? I am not a type of person who says, "Oh, I think the market's going to go down tomorrow. I sell all my stocks." No, it's to me is I have a certain equity allocation. To me, that's lower than most people have, and I haven't added to that as equities have a good run. Obviously, that position has grown a little bit, and I'm just fine with that, right? To me, it's about the risk of what you can afford, and of course, every one of your listeners or viewers has to decide, I think, on the risk that they can afford to lose. And to just go back to 2008, the mistake many people made is in the run-up to 2007 or so that people didn't take chips off the table. And then in the spring of 2009, when we hit the low in the equity market, some people said, "Oh, you got to double down." And even though that technically that would have been the right thing to do, I think it was completely irresponsible. And the reason why I say it was irresponsible is think about you're losing a substantial portion of your net worth, when the markets go down and you were overexposed to equities. And then doubling down on that means you're dramatically overexposed to things that are riskier than you're comfortable with. And so if you look at things from the through the lens of risk management, yes, sometimes you lose out on a gain. But at the same time, I think that you have a better chance of reaching your long-term goals because you don't have to sell out in a panic or whatnot. And so when I make asset allocation changes, I tend to be more a long-term investor. For most folks, it doesn't really matter what strategy they have. My view is they should have a strategy. If you're good day trading, go for it, right? But if you're not good at it, then stay away from it.
Did you or are you planning to take profits on gold or gold stocks this year, given how high gold has run?
Since I'm an insider in a company that's publicly traded, I am not authorized, so to say what I will do in the future.
Okay, all right.
But if you just look at my historic pattern, and there are public disclosures on that, I'm a very long-term investor, so I don't tend to trade in and out of these things. And the other thing I've said is that with the Federal Reserve having changed its bias towards an easing bias, it's a more favorable environment, medium term. And so that obviously is something I'll take into consideration as I look in that space.
Can you just explain the logic here for the audience? Why an easy monetary policy may be conducive for higher gold and perhaps gold mining stocks prices?
Yeah, well, let's take the gold side, which is maybe a little easier.
Yeah.
The gold is the purest indicator of monetary policy. Gold is a brick, doesn't pay interest, and it competes with cash, amongst others.
Yes.
So if you think that you get a real return on your cash, why would you hold gold? Whereas if you think that the purchasing power of cash is eroding, well, then suddenly maybe gold has some value to you. And since markets are forward-looking, you may want to look at the real rates going forward. Now, a lot of people say nobody knows what inflation is going to be in 5, 6, 7 years from now, and that's of course correct. But what the market gives you is an assessment of what the market thinks, and relative changes in that are relevant. And so there, the bias of the Federal Reserve matters. If the bias of the Fed is, hey, I'm cool with a little higher inflation for a while, and I'm more worried about a downturn, then that is something that's more favorable to gold. Also, when you have a more severe recession, the Federal Reserve tends to ease rather rapidly, and gold has the most direct impact on that, right? Because of the discounting mechanism and how people price these things. On the gold mining side, theoretically, that's a levered play on the price of gold. I say theoretically. Imagine let me take some abstract, simple numbers. The cost of production is $1,000 an ounce, and the gold price would be 1,500. The price of gold goes from 1,500 to 2,000. Well, that $500 increase is 100% gain in the profit in the bottom line. Now, that's a theoretical thing, because when the price of gold goes higher, many other costs tend to go higher as well, including the cost of energy, the cost of labor, taxes may go up, and so forth. For the junior mining space, which is often a levered play on the gold miners, because you're literally betting on them striking gold and being able to develop a mine. Often these junior miners only have funding for 2 years or so. They need to go back to the markets. And so there, a tight environment has helped to depress those prices. And even though the rates have been cut, and of course, access to money isn't that easy even yet, but the bias has had an impact. And so you have a disproportionate gain there. And if we were to have a more severe recession, you just have that trickle down even faster, with the potential for a higher upside.
A lower rate environment has had the history of lifting most assets. It's conducive to higher stock price growth. It's lifted gold, as you said. It may even help bond prices, as lower rates increases bond valuations. So how do we as investors decide where to allocate our capital when rates go down and seemingly everything goes up?
Well, we've had times where everything has gone up, right? I mean, the last decade was an example. Buy the S&P 500 and nothing else. I'd like to remind people that that's not how the world usually works, and that's why people diversify. And the one thing about gold is that it has a near zero correlation to equities in the long run, and that can be very helpful if you're worried about something else. And the gold equities, because it's more volatile than the price of gold, you need a small allocation to get kind of bang for the buck, to get a greater degree of diversification. But the question is, of course, why are rates coming down? And usually it's because of a recession. And so, and because markets are forward-looking, just before rates are coming down, it might be a good place to be in those interest rate sensitive things. Once you're at the bottom, right, then you want to be concerned about the next cycle, because then the next thing is, well, when is the Federal Reserve going to tighten? And so depending on how the economy grows, there might be reasons to kind of be in different areas. Of course, I'm overly simplifying here, but market timing is not easy, and most folks might want to stay away from it. Again, that's part of the reason why I encourage people to look at it in terms of risk. Can you afford for this or that to happen? With that caveat, if the markets look perfect, be that for the S&P or for gold, perfect is not a good thing, because when perfection is priced in, then it usually means things are going to get worse.
Okay, perfect. Axel, I appreciate your updates as always. Tell us where we can learn more from you.
Come to merkinvestments.com. We have a newsletter. Follow me on Twitter at Axel Merk, where I cannot tweet about products, but I will keep people up to date on what's happening in the markets from my lens. And as a caution, when central banks meet, I sometimes can get a little nerdy and dive into details.
This is the kind of caution we like now, Axel. Let us all nerd out together. So please check out Axel Merk in the links down below. Thank you very much. We'll speak again next time.
My pleasure.
Thank you for watching. Don't forget to like and subscribe.